Good morning. We'll discuss about accounting ratios, and this is accounting ratios part 2. And I'll just recap what ratios are quickly. Ratio is just a relationship between two variables. It can be a ratio to find the content of water in the milk, right? So it is just a relationship of two variables. In financial terms, we study the relationship of an expense or income is to income, or expense to expense. It can be between any two. For example, we can even study how much sales returns has happened in the total sales. So it is the relationship between these two variables. We'll focus on the four categories of ratios called as liquidity, solvency, activity and profitability ratios. And in part 1 we discussed about liquidity ratios and solvency ratios, and in part 2 we are going to discuss about activity or turnover ratios and profitability ratio. I already explained in part 1, but still we'll explain how ratios are expressed. The result of the calculation will give you in proportion. For example, as said to be the ratio of water in milk. It can be expressed in 0.5:1. It means that in 1 liter of milk, 0.5 liter of water is added. It is in proportion. A ratio can be in proportion. Number 2, the ratios can be expressed in times. For example, 2 times, 3 times, 4 times. So in case of stock turnover ratio, the result comes as 2:1 as indicated here. It is mentioned in times, that is, it is 2 times as highlighted here. The third way of expressing ratios result is in percentage. In case of percentage, you multiply by 100. In case of gross profit ratio, generally gross profit divided by sales into 100 is the gross profit ratio. And for example, if you get 20% as the answer, it is expressed in percentage. So generally ratios are expressed in proportion, times and in percentage. And we'll move into activity or turnover ratios. Right, we have moved into activity or turnover ratios. A business should know the days or the time period it takes, or how many times they roll over inventory, receivables, creditors, or investment, or in case of working capital. To say precisely, if we take inventory turnover, a business should know how many times they ordered and how many times they had converted into finished goods. So the number of orders indicate generally and gives an idea about an inventory turnover ratio. The higher turnover indicates that the production is high, the quicker they process their raw materials. It depends upon the business too. So you cannot assume the standards as in case of liquidity ratios. Right, we'll discuss here one by one. We'll move to inventory turnover ratio. Here we have given in the example inventory in the beginning, inventory at the end. Net purchases, wages, revenue from operations and carriage inwards. So let us know the ratio. Inventory turnover ratio is cost of revenue from operations, or it's called as cost of sales or cost of goods sold, right, divided by average inventory. This is the ratio. So to find the cost of revenue from operations, we add up inventory in beginning plus net purchases plus wages plus carriage inwards minus inventory at end. It is like adding all the items in the left hand side of your trading account and subtracting with the items in the right hand side of the trading account. That is all. So you will get cost of revenue from operations. Then to find the average inventory, you add the inventory at beginning and inventory at the end and divide by 2, you get average inventory. So after getting average inventory, you put it as a ratio to find out the inventory turnover ratio. For example, if it is the cost of goods sold is 3 times and 3:1, then it means that the inventory turnover is 3 times of the average inventory, right? So that is how inventory turnover ratios are calculated. And one more thing to add to inventory turnover ratio, this ratio is an indicator of how many times we have turnover in a year. Generally, strictly speaking, this turnover is an idea. We cannot expect same thing to happen throughout the year. As you know, certain times it is seasonal, certain times it is not seasonal. The business is not seasonal, right? We'll move to the next ratio, trade receivables turnover, or you can call as accounts turnover or debtors turnover ratio. You can call it in any words. Right, this ratio expresses the relationship between two terms again. Here it is net credit revenue from operations. It means, as said by me, cost of goods sold. It can be cost of goods sold. And average trade receivables, right? So we calculated those things, and we can see here how it is calculated. And we have calculated the trade receivables turnover ratio as 8.18 times. Remember, it is 8.18 times. So in a year, the trade receivables happen 8 times. We buy goods, that means we buy raw materials, convert into finished goods, and after the finished goods are converted, we make into sales, credit sales, and credit sales move through the process and is converted into cash. And the moment we give credit sales and convert into cash happens 8 times in a year, right? So in short, we can also calculate the credit collection period. So the credit collection period is calculated by dividing 365 days by the trade receivables turnover ratio. We have found 8.18 times above. So we divide 365 divided by 8.18, will get 45 days. So 45 days means, it takes 1.5 months to convert the credit sales into collection or cash. So if it takes 1.5 months, we have 12 months in a year. So how many months, how many times it rotates. So it is 8.18 times. We can reverse work too to find this 8.18 times, right? Here it is added, and you have not divided, you have divided by those things, the formula. I have failed, I have forgotten to put it correctly. So here you have got the net credit, right? It is divided by this average trade, that is 59,000 plus 48,000 divided by 2. We will get the average receivables, right? So after doing that, you get 8.18, then your collection period. We will move to the next slide. It is about trade payables turnover or accounts payable turnover or creditors turnover ratio. You can call it any name. It is an expression with the help of net credit purchase. There it is sales. Here it is sales actually. Net credit revenue from operations is net credit sales. Right? In this, here also it is mentioned, we take into debtors into consideration. Here we take creditors into consideration. So net credit purchases divided by average trade payables. So here we have taken average trade payables. So to calculate average trade payable, it is simple. Opening creditors or accounts payable divided by closing creditors or account payable divided by 2. Trade payable turnover ratio. Net credit purchases, and you have the formula here. Substituting this, the values in the formula as given here, you will get 2.96 times your accounts payable or creditors turnover ratio is 2.96 times a year. You don't have any general standards, as the standards vary from industry to industry. For an example, a spinning mill might have a different creditors payable or creditors turnover ratio, whereas if you take a case of a business where you do in manufacturing a two-wheeler, there your creditors turnover ratio might be different, because two-wheeler automobile industry is different from a spinning mill. So spinning mill industry has its own credit period. Maybe a groundnut oil has a different credit period. So the collection period varies according to the nature of industry. And to see the payable period, how many days we have taken to pay our creditors, we can calculate in simple ways. 365 days divided by the credit turnover ratio, which is 2.96. We have calculated here, it is 2.96. So it is very clear that in a year, just around 3 times we have paid. Just 3 times we have paid. It means for every 4 months we have paid the creditors. For every 4 months we have paid the creditors. 3 times a year means you just divide 12 divided by 3, we will get 4 months. So we will convert into days and see. For that we have divided 365 divided by the creditors turnover ratio, which is 2.96. We get 123 days. So after making credit purchases, we have paid in 123 days. So in a year we generally pay 3 times. So this is about creditors turnover ratio, and the turnover ratio varies from industry to industry. Keep that in mind. So whenever you calculate this ratio, you should know the industry standards. This might vary for banking industry too. Next is investment to capital employed, sometimes called as net asset turnover ratio. We'll just quickly look in these ratios continuously. Here I have given an example, because these ratios doesn't have standard. I have shown you a statement of assets and liabilities here. This is a statement of assets and liabilities. So from the statement I have taken various values and calculated the asset turnover ratio, working capital ratio, and so forth. So I'll just explain in quick. Net asset turnover ratio is an indicator of how many times how many times the asset it has been turned over. For an example, we'll see here. Revenue from operations means the sales. So we are going to see how many times of your net asset the sales has been made. So for example, if your net asset is 1 lakh, your sales has to be at least 1 lakh, right? Minimum 1 lakh. The more the times of your net asset, the good is your fixed assets turnover ratio. This also varies from industry to industry, right? So we can have calculate it. The revenue from operations is 3 lakhs. You can see it is calculated, and then the capital employed is calculated by adding share capital, reserves and surplus, and long term debt. We have shown how it is added. So you have 18 lakhs, right? And the fixed assets you have added, you have 16 lakhs. You can divide and make fixed assets turnover ratio, right? So similarly, you can also calculate the working capital turnover ratio. Working capital means the capital required to do the day-to-day business. So working capital is about your current assets and current liabilities. When you call as working capital, it means your current assets alone. When you call as net working capital, it means current assets minus current liabilities, right? So here when you subtract current assets from current liabilities, you get net working capital, right? So there are more ratios, there are more turnover ratios. I have taken basic important ratios to give you an idea about how ratios are worked. And as said by me, these ratios vary from industry to industry. So here are the calculations. You can see the calculations are made from the earlier slide. You can see 3 lakhs and 18 lakhs, 30 lakhs and 18 lakhs. So it is 1.67 times. Here it is 30 lakhs actually. 30 lakhs plus 18 lakhs, right? We will correct it. So it gives you 1.67 times. It means that your assets are more. It is good. It is good. So your sales are making more than your assets. You can see here, your sales are more, your sales are better than higher than your assets. That is good. It is a good indicator. 1.67 times is a good indicator. Asset turnover ratio is 1.88 times, and it is also a good indicator. Anything more than 1 time is a good indicator. And it varies from industry to industry. Certain industry will demand at least 4 times, right? So basically 1 time is good, but you should know the industry standards for each ratio. And in capital turnover ratio, it is 15 times, right? And as said by me, in certain industries it is high, and in certain industries it is low. Times is expressed in activity turnover ratios, right? We'll move to the next category of ratios called as profitability ratios. To know long-term solvency, we calculated solvency ratios. And what is the motive of profitability ratios? We know what profit we have made in our business. What is the use of profitability ratios? For an example, to know health of a person, a daily health of a person, you will know how comfortable in getting up from bed. You will have to see how comfortable you were in going to bed. You need to know how well you are able to do your day-to-day work, right? And finally, how well you enjoyed and take your food. Food is about dividend, remember. Food is about dividend. So we'll look in each and every aspect. So this is about an year's work. How this year the performance was. It shows in profitability ratios. So even if we're going to invest in a company, you are going to choose a company to invest in share, you are advised to do profitability ratios if your investment is short term or long term. If you are going to invest in shares for a long term, you also do solvency ratios. Good if you do turnover ratios too, but at least profitability and solvency ratios has to be worked to know when you are going to go for long term investment. If you are going to go for short term investment, basically you are advised to do profitability ratios at least, right? So investor generally does a fundamental analysis, right? In fundamental analysis, this ratio plays a vital role, right? We'll just go in quickly about this profitability ratio. We'll just take the financial statement, that is from trading account. You'll be able to take gross profit and you'll have sales in the trading account. You divide that and multiply by 100. Net revenue from operations is net sales. Net from revenue from operation is nothing but net sales. So from net sales, you are going to you divide gross profit divided by net sales into 100 will give you gross profit ratio, which is 40%, which is good. And remember, this gross profit ratio standards vary from industry to industry. For an example, generally any manufacturing industry has a profitability of 10%. But certain industry has a high investment, high volume of turnover, will have around 4 to 5% as gross profit. Right? So it varies from industry to industry. We will move to the next gross operating ratio. Here it is given, the formula is given, how it has to be found. You divide the cost of revenue from operations plus operating expenses divided by net sales. You multiply by 100 to get in percentage. So profitability ratios are generally in percentage. Not all profitability ratios, but most of the profitability ratios are in percentage. Operating ratio is one of the important ratio. You can either subtract 100 from operating ratio to find operating profitability ratio or calculated as given here. Right? If you are going to calculate as given here, it is the ratio. You can see operating cost divided by net revenue or sales multiplied by 100. Operating cost is set as operating expense. This operating cost is set as operating expense. So you get an operating ratio of 70.59%. So from the operating ratio, you calculate this operating profit ratio. So what do? You subtract 100 from this operating profit ratio. You get you subtract 100 from operating ratio. You get operating profit ratio of 29.41. So this is how you calculate operating profit ratio. It is also expressed in percentage. 29.41% is a good operating profit ratio. We'll move into net profit ratio. It is simple. Here you divide net profit by net sales. Here it is given as net revenue from operations, which is nothing but net sales. You multiply by 100, and here you get a percentage of 22.75%. This shows the business is good. 22% of net profit is good. After net profit, you are going to subtract if you have any interest. Then you are going to subtract tax, and after paying interest and tax, you declare dividend, right? So net profit of 22.75% is good. We'll move into return on investment ratio, or we call as return on capital employed. So this is the ratio. Profit before interest and tax divided by capital employed, you get return on investment ratio. This is called as ROI. So you will have to look in what ROI your company is having before investing in this company share. It is a good measure before investing in any share. We'll move to the next ratio, which is return on net worth or shareholders fund ratio. This ratio is important from the shareholders point of view, as said by me from the investors point of view. So here what we do is we take profit after tax and divide by shareholders fund, which means you add equity and reserves and surplus. For shareholders fund, you add equity plus reserves and surplus. You divide profit after tax divided by shareholders fund and multiply by 100, you get return on shareholders fund. So before investing in any company share, it is good to calculate return on shareholders fund. Next important ratio from the investor point of view, from the shareholder point of view, is earning per share. If you take Economics Time newspaper, you can see a column which is provided for earning per share. You have invested rupees 10 in a share. Per share face value is rupees 10. You should know how much this 10 rupees have earned this year for the company. This is earning per share. So what you do is take total profit available for equity shareholders. It means profit after tax. Divide by number of equity shares. You will get earning per share. Right? So it is clear, profit after tax minus you take dividend. Sometimes when you have dividend preference shares, you will have to subtract dividend declared to preference shares before calculating profit available for equity shares. Right? So this is an important ratio that is calculated by an investor before making short-term investment or long-term investment. The next important ratio from the investor point of view is book value per share. It is calculated by dividing equity shareholders fund by number of equity shares. So you will have to know this ratio. It is called as book value per share. So here equity value per equity shareholders fund to shareholders fund minus preference share capital is the way in which you calculate. So remember, from the equity shareholders point of view or from the investor point of view, this ratio is important. So we have calculated a list of ratio, and finally last but one, we are moving to dividend payout ratio. As a short-term investor or as a long-term investor, if you are going to choose a blue chip company looking for fundamental analysis, it is good you look into dividend payout ratio, right? So the ratio is given dividend per share divided by earning per share. For an example, if a share has earned 5 rupees this year, share has earned 5 rupees this year, and dividend is given, 1 rupee is given as a dividend. 1 rupee is given as a dividend. It means rupee 1 divided by 5 is earning per share. Right? This is approximately or exactly 0.2 rupees. 0.2. So the dividend payout ratio is 0.2. Just take out this, it is not expressed. You can have it as rupee, but it is 0.2. The dividend payout is 20%. It is not rupee, it is just 20% of earning per share is paid out as dividend. So 5 rupees it has earned and 1 rupee is given as dividend. It means 20% is paid out. The dividend payout is, you can say, as 0.2 or 20%. 1 divided by 5 multiplied by 100 will give you 20%. The next is price earning ratio. Price earning ratio is one of the important factors for a long term or short term investor. If you look in Economics Time newspaper or Financial Express newspaper or any website, when you analyze shares, they would give the price earning ratio. Even though you don't do fundamental analysis and you are laying on technical analysis, means still we advise and all technical analysts would calculate price earning ratio, because this ratio is based on market price of a share. So even though your analysis is based on technicals, still you do this ratio. So this is a wonderful ratio wherein you have market price per share divided by earning per share. Right? So if your market price is rupees 100 and your earning per share is 10, that gives you a PE of 10, a price earning of rupees 10. It means that your market share is 10 times the earning per share. It is 10 times the earning per share. If you convert into percentage, it will go higher. If you put into 100, you will get 1000%. So your market price is 1000% than your earning per share. So you can say in different words. One example is given here. That is how I have explained this example in simple ways. So we have discussed about profitability ratio 2, and apart from this there are more ratios, and these are the basic things that every investor, short term or long term investor, should do to be cautious. Even though you are running a company, it is good as an entrepreneur to do this ratio analysis, to know your financial performance, where your business is. So these ratios are good for investors too, and for entrepreneurs too. Entrepreneurs, it's good to know their financial position. Thank you for your patience. Have a good day. வாழ்க வளமுடன்.